All right, let's talk about building a portfolio that doesn't just survive chaos, but actually gets stronger from it. We're going to be looking ahead to the potential shakeout around 2026 and asking the big question: is your portfolio truly ready for what's coming?
This right here, this is the crucial question. Because everything you've been told about diversification, well, it might be dangerously wrong. You know that feeling when panic hits the market and it seems like everything is falling all at once? We need to understand why that happens.
So, first, let's talk about the symptom. That absolutely terrifying moment when all your carefully picked assets, the ones you thought were totally different from each other, all start bleeding red at the exact same time. We've all heard it a million times, right? Don't put all your eggs in one basket. It's investing 101. But here's the catch they don't always tell you. What if all your different baskets are sitting on the back of the same truck, and that truck is headed for a cliff? You haven't actually diversified your risk, you've just kind of disguised it. Now, this isn't just theory. Look at this real-world stress test from the COVID crash. The S&P 500, bam, down 34%. Gold, the classic safe haven, did its job beautifully, only down 2%. But look at Bitcoin. It's often called digital gold, but it plummeted almost as hard as the stock market. Not much of a safe haven there. And this number, wow, this number tells the whole story. 0.91. That means that during that panic, Bitcoin and the S&P 500 were basically holding hands and jumping off the cliff together. That hidden connection, it only showed up when things got really ugly. Okay, so if that's the symptom, everything falling at once, what's the actual disease? We got to diagnose the underlying condition that makes our portfolios so vulnerable. And the disease is correlation. So the whole game of true diversification isn't just about owning different company names. It's about owning things that behave differently. You're hunting for assets with a correlation near 0 or even better, a -1. You want something that zigs when everything else sags. This quote just nails it. It's so powerful. You know, owning 10 different big tech stocks isn't diversification. It's just one giant concentrated bet on the tech sector. If your biggest risk is the price of oil, owning 10 different oil companies doesn't help you one bit. And this slide just lays it out, clear as day. On the left, you've got what looks like diversification, but it's really just 4 flavors of the same ice cream. On the right, that's actual diversification. You've got assets that thrive in completely different environments: growth, fear, inflation. That's a structure that can actually withstand a storm. So, how do you check for this hidden sickness in your own portfolio? How do you take its vital signs? Well, there are specific numbers you can look at to measure its health and, maybe more importantly, uncover those hidden risks. Think of standard deviation as measuring a stock's personality. You know, is it calm, cool, and collected? Or is it prone to these wild, dramatic mood swings? Just knowing that helps you understand what you're really signing up for. And then there's beta. Beta tells you how much your little boat is going to rock when the entire ocean gets stormy. If the S&P 500 is the ocean, a stock with a beta of 2.0 is basically designed to move twice as much, up and down. And here's where it all connects. A portfolio that's just jam-packed with high beta tech stocks, it isn't diversified against a market downturn at all. In fact, it's the opposite. It's basically a leveraged bet on the market going up. So when the market does turn, a portfolio like that is probably going to fall even harder. So we've diagnosed the illness. Now, what's the treatment plan? This is about moving beyond just simple diversification to build a portfolio that isn't just robust, but is actually anti-fragile. Okay, so think about it like this. A glass teacup is fragile. You drop it, it shatters. A steel ball is robust. You drop it, it's fine. But what about something that actually gets stronger from stress, like our immune system when it fights off a virus? That's antifragile. It's a powerful idea from Nassim Taleb, and our goal is to get our portfolio all the way over to the right side of this chart. So, one way to build a robust portfolio is with something like Ray Dalio's all-season strategy. The whole idea is that it's designed to do okay, not great, but okay, no matter what the economy is doing. Inflation, deflation, whatever. It's built to resist shocks. But to get to that next level, to be truly anti-fragile, to actually profit from chaos, you can adopt a much more extreme strategy, and that's where the barbell comes in.
Now, this is a fascinating concept. You put the vast majority of your money, say 90%, into something incredibly safe. Think treasury bills. Your downside is tiny. But then, with that remaining 10%, you go for broke. You put it in super aggressive, high risk stuff, things with explosive, unlimited upside. So when chaos hits, your losses are capped. But if just one of those little bets goes to the moon, your gains are wide open. That's the core of an anti-fragile strategy.
Another tool you can use is what I like to call portfolio insurance. Take the VXX, for example. It's an ETF that basically tracks fear in the market. It's designed to have an inverse correlation to stocks, so when the market crashes and everyone is panicking, the VXX tends to spike, acting like a fire extinguisher on the rest of your portfolio's losses.
So we've got the prescription, we know what to do. But now comes the really hard part. These are the doctor's orders, and they can be a very, very tough pill to swallow. And this is just the brutal, honest truth. Paying for that portfolio insurance or holding onto boring assets like cash, it feels awful when the market is roaring. It's painful to watch your friends' all-tech portfolios go to the moon while you're sitting there holding your hedges, feeling like you're missing out on all the fun. And that feeling, that fear of missing out, leads to the single biggest psychological mistake. People get tired of paying for that insurance. They get impatient. And so they throw their fire extinguishers out the window, right as they're starting to smell smoke coming from under the door. So that's the final thought I really want to leave you with. Take a good, hard look at your portfolio. Is its strong performance a result of a truly resilient, well-designed strategy? Or have you just been lucky, surfing a really good wave, totally unaware of the giant rocks hiding just beneath the surface? The answer to that question? Well, it could define your entire financial future.